Like I often do, I'm going to give you both sides of what's going on with the stock market. I'm going to give you Mike Wilson, who has taken a view of it's bullish, and he's taking this, the view of this is the beginning of a new bull market, actually. And so even a kind of a macro view of bull. And then David Hunter, economist, will give the pessimistic view that he thinks we're heading into a crash. And both give substantive reasons why they think their view is valid. So depending on which view you have, you will find someone with that view who is credible. But I see both. I usually see more of the negative, but it clearly is, no one knows. And so if you're thinking the market is going to go down, you know, there are some people who agree with you with good reason, and vice versa. So anyway, let's begin. My name is Ben Reppond. Thank you for watching. Welcome to my podcast. Today is the 26th of August, 2025. Okay, let's begin with Mike Wilson. Mike Wilson is the chief equity strategist for Morgan Stanley. I've played him before. I like him. He's obviously credible. He's voted by his peers on Wall Street as the best money manager on Wall Street. And I want to say thank you to Hal, who's one of my viewers. And Hal pointed me to this, and I wouldn't have found it otherwise. And you may not agree with him. You may not agree with Mike Wilson. And I'm not saying I do necessarily. I think he is right in the long run. He takes it back to early April. So the market from last summer until the first week in April was in some kind of a decline component, especially during the last part of that, February and March. And so then it bottomed, I think, around April 7th. And if you look at a chart, it just kind of goes straight up from there. So it kind of formed a V bottom. And that's a good sign for that being the beginning of a bull market. Anyway, that's what his thesis is. And but it didn't really go, other than just kind of that chart component, doesn't go into many other reasons. But anyway, I'll play this, and then I'm going to play David Hunter as on the other side, so you can see both views and their supporting material. So take a listen to Mike Wilson.
So let's kick off and dive in with Morgan Stanley's chief U.S. equity strategist, Mike Wilson. Mike, it's great to have you back on the program. A lot of people, they may have sold during the panic. They haven't been back in. They're waiting for an entry point. Is that coming?
Well, good afternoon, Brian. I mean, look, I don't know if they're going to get a big fat pitch like we got in April. That's probably very unlikely. We think ultimately that was the end of a pretty significant bear market. We're in the beginning of a new bear market. It's still about only 4 months into that. So, you know, pullbacks will probably be shallower than people want. I mean, that's the classic sign of a new bull market. It doesn't really let anybody in. The good news is, you know, our data suggests that the retail investor really didn't sell in April. In fact, they were buyers all the way through that period. It was really more the institutional community that created that low, and a lot of the passive strategies, quite frankly. And it was so quick that many people didn't even have time to react. So my suspicion is most of the viewers probably have plenty of equity exposure. They're probably enjoying the ride. The question they probably are asking themselves is, should I be selling here because I made so much money? And in that case, you know, that's a personal decision. You got to pay taxes. If you do that, my suspicion is if we get a pullback, it'll be probably less than 10%, which in the grand scheme of things, that's not worth trying to trade around for most people.
So you believe we started a new bull market back in April. Why?
Because we had a bear market. And I think that's the thing that people don't really acknowledge, which is that, you know, the sell-off in April was really a final capitulation to a bear market that began last summer. If you actually look at most stocks, they topped in July of 2024. They were down anywhere between 30 and 35% on average. I mean, that's a proper bear market that ended with a capitulatory price action. So whenever you get that type of price action, you have some demarcation between the bull market and the bear market. That was it. It was the capitulation. So, most bull markets don't last 4 months. They last, years, or year or two at a minimum. So I think right now we're in buy the dip mode because we're in that bull market mentality. And the question now, and I think you were alluding to it earlier, is like, what should I own? And I think, we're probably getting to the stage of this bull market where you can probably see some broadening out. Maybe that's one of the reasons why we're seeing the Mag 7 start to maybe underperform a bit now. And that's really going to be contingent, in my view, on when the Fed starts actually cutting interest rates. I don't know if they're going to do it in September or not. But once they start actually doing that, that's when you'll probably see the bull market really broaden out.
The second piece I want to play for you is David Hunter, economist, and he takes the other view, which is that the market is going to crash. Now, he takes the position that the reason for it is leverage. Now, you could take leverage to mean debt, and you could take it to mean, margin or derivatives. All of that, I guess you could say, in one form or another, is actually debt. But because there's so much leverage in the market, that that does sort of make sense. But he believes that the market will go down, he said, around 80% in the next, maybe this year or into, I'll just say, early next year. 80% decline, even if it's for a short period, is a deep decline. In 2008, the market went down 56%. So you think, okay, half again on top of that. Well, I can just tell you, people would freak out if that happened. And, but anyway, he gives that side. So if you think the market's going to decline or it's imminent, you would probably enjoy David Hunter. But it's just two contrasting views. So anyway, I'll play this piece for you. Jay Martin interviewing David Hunter.
Okay, so probably good at this point. I want to revisit your global economic thesis that we've touched on a few times on this show, but I haven't had you on in probably 4 or 5 months. So I'd like to revisit this. If you could just start essentially from the beginning, what is your global economic thesis? And then I'll pull on some threads from there, David.
Okay. Yeah, my view has been and continues to be that the economy is moving towards recession, and that because of the leverage in the system, which is beyond anything we've had in any previous cycle, so far beyond 2008-9, far beyond 2020, we're looking at 330 trillion in global debt. We're looking at quadrillions in notional value of derivatives. So I describe the debt as leverage on the financial system, leverage on the economy, and derivatives as the leverage on the markets, fixed income, equity, metals, everything. There's so many derivatives out there. And people don't realize we really didn't have derivatives before the mid 80s or late 80s. So we've just exploded in terms of, kind of a tail wagging the dog in a lot of ways. With that leverage in both on the system and on the markets, I believe this is going to be far bigger than 2008-9. So as I say, 2008-9, we almost went over the cliff, but when the commercial paper market froze and GE almost went under, our policymakers acted just in time and kind of pulled us back from the edge of the cliff. We had a rough what they call a Great Recession, but we didn't go over the cliff. I think this time the potential is there for us to go over the cliff, meaning I call it global bust, but basically meaning something that leads to lots of bank failures, big bank failures across the globe, probably more so overseas than the U.S. this time because our banks were forced to clean up their act and get, unlevered, deleverage a lot. So they're still vulnerable, and certainly the counterparty risk means that if something happens in the big banks in Europe or, your banks or, over in Japan, our banks are in trouble too. But that's my thesis, just very simply, the leverage this time around could take what would have been an ordinary recession and turn it into something greater. I'd find a bust as something that'll feel like a depression, but not last for more than 12 to 18 months. So, the unwind will happen very fast relative to what a depression is. But it will come with a lot of certain a lot of pain while you're in it. I think the stock market can drop as much as 80% peak to trough. People have a hard time with that part of my forecast now, because obviously we are nowhere near that, seemingly nowhere near that. We're questioning whether we're even going to see a recession. I think right now you can get a very long extension or steep extension to the bull market, because I think there's enough buoyancy in the market to allow particularly institutions to believe it's a soft landing. So, but I believe it's going to be a hard landing starting next year. Could even begin by the end of this year. I think, as we saw in 2008-9, when things tip over, they can get pretty ugly pretty fast. So you have to be careful not to be lulled to sleep. I remember September of 2008. I was calling for a hard landing, and I had no company. The vast majority of economists on the street were saying soft landing, no recession in sight. That was 3 weeks from Lehman Brothers. So things can happen fast, particularly in the financial world. You can think everything's kind of, not that it's great, but it's not bad, and then go from soft landing to hard landing expectations in a hurry. So I don't know if we'll see it that quickly, but that's kind of my guess, is that next year is going to be the bust.
And then finally, I want to play 1 minute of an interview with Jim Bianco by Julia LaRoche, and where he talks about his opinion on interest rate cuts in September. So take a listen.
I just want to start with your kind of big picture reaction. What's your take from Powell's remarks today?
He caved, and he's going to cut rates in September. He was pretty adamant for most of the year, giving arguments for why the Fed needed to be very cautious about cutting rates. And now he's kind of, done a bit of a right turn. I wouldn't say a U-turn, but a right turn. And he's now looking towards the idea that the Fed needs to worry about the perceived slowdown in the labor market and cut rates, even though the inflation numbers are too high and they're expected to go up even more. So given that conflict, again, like we saw last year, the Fed is going to say bad inflation numbers, bad employment numbers, cut rates. They did that last year. It didn't work, because what happened was long-term rates were more worried about inflation and they went up. They're going to try that again this year. We'll see if we get the same result as last year, or we get something different.
Okay, thank you for watching. If you have questions or comments, leave them in the comment section below.